You opened a new app last week. Maybe it was a trading platform, maybe a crypto wallet, maybe just a budgeting tool. And within 48 hours, you saw an ad for it. On Instagram, on YouTube, on the website you were reading at midnight. Here's the thing nobody tells you. That was not a coincidence. That was a system. And that system was built specifically for you. Not because you are smart with money, not because you show financial promise, but because of your age. Let us talk about something hiding in plain sight. Financial companies spent over $30 billion on digital advertising last year alone, and a disproportionate slice of that budget goes toward one demographic: people aged 18 to 34. Not retirees with the most savings, not 45-year-olds with the most assets. You. Why? That is the question worth sitting with, because the answer reveals something uncomfortable about how the financial industry actually sees young people, not as customers to serve, as customers to acquire. There's a difference, a big one. Here's how a bank or fintech company thinks. They do not think about your bank balance today. They think about your bank balance over the next 40 years. This is called lifetime value. And for a 22-year-old, that number is massive. If a financial platform acquires you at 22 and keeps you until 65, that's 43 years of fees, 43 years of interest margins, 43 years of cross-selling, insurance products, investment accounts, mortgages, car loans, credit cards. It stacks. A 35-year-old customer gives them 30 years of value. A 22-year-old gives them 43. That extra 13 years is worth hundreds of thousands of dollars to them per customer. So when they spend $50 to acquire a 20-year-old through an Instagram ad, that's not a marketing cost. That's an investment with an extraordinary return. Now here's where behavioral psychology enters the room. Financial habits form early and they stick. Studies in consumer behavior consistently show that the financial products people adopt in their early 20s are the ones they keep for decades. Not because those products are better, because switching is painful. Because one day your salary lands in that account, and your rent leaves from it, and your card is saved on every subscription. You're locked in, without anyone forcing you. This is not an accident. Financial companies study onboarding friction obsessively. Every extra second it takes to link another bank account is intentional. Every loyalty point that doesn't transfer is a chain. Every user interface built to feel familiar is engineered comfort. They're not building products, they're building habits, and they want yours while they're still forming. Here's where it gets darker. Young people aren't just attractive because of their potential income, they're attractive because of their data innocence. When you're 50, financial institutions already know everything about you. Credit bureaus have decades of your behavior. Banks have your full transaction history. But at 22, you're a fresh data profile. Every financial interaction you have is new signal. Where you spend, how often you overdraft, whether you pay minimum balances or clear them. This data gets sold, packaged, turned into credit scores, risk profiles, behavioral clusters. And it's worth more when it's fresh, because it predicts a longer future. You're not just a customer, you're a data asset at peak valuation. Let's pause and do the numbers properly. The average American switches their primary bank once every 16 years. 16. Get someone at 22, keep them to 38. By then, you've earned the margin on their first mortgage, their first investment account, their first life insurance policy. And there's a 60% chance they never actually leave, because switching banks, even now, still takes effort, and effort is the enemy of action. Financial companies are not betting on your loyalty, they're betting on your laziness, politely speaking, and statistically, they win. Now here's where the story gets ironic. Every ad targeting young people uses the same vocabulary: freedom, control, your money, your rules, zero fees, empowerment. But read the fine print on that zero-fee checking account. That fee is being paid by selling your spending data to advertisers, or by cross-selling you a premium tier in 6 months, or by charging interest on the credit product they'll offer you after 90 days of onboarding. The freedom narrative is real in the interface. It's a different story in the business model. You're not the customer in the way you think you are. You're the product being optimized. And the ad that felt like it spoke directly to you? It literally did, because an algorithm trained on 10 million young adults decided which version of the ad would land best on someone with your exact behavioral fingerprint. Step back even further. What happens to a generation whose financial literacy is shaped by companies with a direct commercial interest in certain outcomes? When your first lesson about investing comes from a trading app that profits on transaction volume. When your first credit product is designed to be easy to open and sticky to close. When your YouTube ad that teaches you about compound interest is made by the same fund that charges you a 1.5% management fee. The education and the sales pitch start to look identical, and that's not a coincidence either. So here's where we land. Financial ads target young people more than anyone else because young people offer the highest return on acquisition, not because of what they have, because of what they will have and how long they'll stay. The system is not irrational, it's perfectly rational, from one side. The question no one fully answers yet is this: if your financial habits are being shaped by companies whose revenue depends on specific versions of those habits, how much of your financial life is actually yours? And how much of it was designed for you before you ever had the choice to choose?